Welcome to the Deep Dive. Today we're digging into Bath & Body Works Q2 2025 earnings call.
Yeah, and it's a particularly interesting one. It's CEO Daniel Heaf's first full quarter.
Exactly, 105 days in. So his strategic direction is really starting to take shape, setting the stage.
Right, and for you listening, it's key to understanding how this established brand is adapting with new leadership at the helm. We're looking for those clues about where they're headed.
Okay, so let's jump straight into the Q2 results. Just a snapshot first. Adjusted EPS came in at $0.37.
Which was like a penny short of the LSIG consensus, right?
Yeah, just a tiny miss on the bottom line. Revenue, though, that was pretty much bang on expectations. $1.549 billion.
Showing a little bit of growth, about 1.5% year over year.
But the operating income, that told a slightly different story.
It definitely did. It dipped down to $157 million, or maybe $172 million adjusted, down from last year.
So even with stable revenue, there are some cost pressures underneath.
Clearly. And when you break down that revenue, the channels are interesting.
Very. U.S. and Canadian stores were pretty strong, actually, up 4.9%, almost $1.2 billion there.
With the direct channel, their e-commerce, basically.
Yeah, that saw a big drop, 10.1% down to $267 million.
Although, to be fair, they did point out if you adjust for buy online pickup in store, which now counts as store sales.
Right. Then the digital decline was closer to 3%, still down, but less dramatic.
And international softened a bit too, down about 2.9%.
So you immediately see that challenge, don't you? How does this very sensory in-store brand really nail the digital experience?
And the market noticed. Shares dropped, about 6% in pre-market?
Yeah, with decent volume, too. So investors were definitely sensitive to that EPS miss, but also, crucially, the forward guidance.
Okay, let's get into that strategic direction then. The CEO, Daniel Heaf, talked about his first 105 days and these 3 no-regret moves.
Right, putting the consumer at the center. What exactly are these foundational no-regret moves?
Well, think of them as like essential upgrades. Things that make sense no matter what happens in the market long-term. Good foundational stuff.
Okay.
So the first one, elevating the digital experience. And they were pretty open about it, weren't they?
Yeah, they basically said it's underperforming, not meeting expectations, not driving enough revenue.
So the plan involves a new app coming in September and then a mobile web relaunch starting in October.
They're aiming for something more experiential, frictionless, convenient.
Right. No specific growth targets yet, but they expect it to drive growth over time.
But is it really enough in such a competitive digital space?
Well, it might be more about catching up, honestly, making digital less transactional and more about that brand feeling, that emotional connection Bath & Body Works is known for.
Extending the in-store discovery online. Makes sense.
The real test is if it actually feels different, less like just scrolling a catalog.
Okay, second, no regret move, amplifying product efficacy.
Yeah, this is about communicating claims better, modernizing packaging, things like dermatologist-tested labels.
48-hour hydration on lotions, focusing aromatherapy on stress relief or sleep.
It feels very targeted towards younger consumers, right? More ingredient focused.
Absolutely. It's shifting from just smells nice to works well. They're kind of taking on those newer beauty brands that have really captured Gen Z with that focus on ingredients and benefits.
It's a catch-up play, for sure, but they have massive scale. The question is how fast they can shift perception.
And the third move is about getting in front of new customers, especially that Gen Z demographic, expanding distribution.
Right, exploring new channels. The big example was rolling out into over 600 college bookstores.
Yeah, through partners like Barnes & Noble, Follett, aiming for 7 million young consumers. It's a low-cost way in.
Clever, low CapEx test. But does it convert later?
That's the million-dollar question, isn't it? Is it just discovery, or does it lead to full-price sales down the line?
They called it the first of many initiatives, so it's clearly an acquisition test, finding new paths to that younger crowd.
Okay, so moving beyond strategy, back to the Q2 numbers in more detail. Gross profit rate was actually a bright spot.
Yeah, it expanded to 41.3%, beat expectations, which is pretty good, considering.
The tariff headwind, yeah, $16 million, about 100 basis points.
And part of that improvement came from exiting a third-party fulfillment center, optimizing things internally.
But on the flip side, SG&A was pressured.
Definitely. Adjusted SG&A was up to 30.2% of sales. That's 110 basis points of deleverage year over year.
Driven by investments, right? New off-mall stores, training, healthcare costs, tech spending.
Yeah, investing in the future, but it hits the margins now. And they expect similar pressure in the second half.
Though they did mention that Fuel for Growth program, which historically has cut costs.
True, about $300 million over a couple of years, so that's a lever they can potentially pull.
Inventory was up 13%, partly tariffs, partly pulling things forward strategically. But they said they exited clean.
And the real estate shift continues. More off-mall. They're now 58% off-mall.
Opened 20 new ones, all off-mall. Closed 16 mall stores.
And those off-mall spots are performing better, higher conversion rates. It shows they're adapting to where people actually shop now.
Okay, so let's talk guidance. This is where the market really seemed to react.
For the full year, fiscal 25, they actually tweaked the EPS range upwards slightly at the low end. Now $3.35 to $3.60.
Up from $3.25. And they narrowed sales growth guidance a bit, plus 1.5% to plus 2.7%.
Plus, free cash flow still looks strong, $750 to $850 million.
Yeah.
And they boosted the share buyback plan to $400 million.
So not all bad news on the full year front.
No, but then came Q3. That's what spooked people.
Right. Sales growth projected at plus 1% to plus 3%. So, okay there. But the EPS, $0.37 to 49 cents.
Which is way below last year's $0.49, a big drop.
And the main culprits, tariffs and SG&A.
Exactly. A huge $40 million tariff impact just in Q3. It's like 240 basis points of pressure.
Wow.
And SG&A expected around 31.5% because of those ongoing investments in healthcare, tech, and strategy. It's a heavy near-term burden.
Let's talk more about those tariffs. It's a major theme.
Yeah.
$85 million negative impact expected for the full year.
Yeah, with that big chunk, $40 million hitting Q3 specifically, you've got the 145% China tariff on some items, plus those Canadian retaliatory ones that were around until September 1st.
It's a lot to navigate. How are they mitigating it?
Well, their big advantage, they say, is their supply chain. Mostly U.S.-based, vertically integrated, but 80% sourced here.
So that helps absorb costs.
Hopefully. They're also optimizing the supply chain, making assortment changes, and trying to use strategic pricing, basically emphasizing product benefits to justify higher prices, less reliance on promotions to drive that AUR, the average unit retail.
Trying to build perceived value instead of just discounting. A tough balancing act.
Very. And beyond the no-regret moves, the CEO also flagged other opportunities.
Like refining the assortment, making it less overwhelming.
Yeah, and using those massive store windows for actual brand storytelling, not just sales signs.
Yeah.
Plus, leveraging their supply chain hub, Beauty Park, for faster innovation and international expansion.
And the marketing is shifting too, right? Less promo-driven, more about connection.
Totally. Better digital stories, like for that Disney Villains collection. They've got a new multi-year Disney deal, too.
And rethinking social media, Instagram, TikTok as a growth system, content, community, creators, commerce.
Right. They even improved the semi-annual sale, apparently, by shifting timing and using social media differently with influencers and their mascot, Billy the Duck.
Billy the Duck, okay. It sounds like they get that consumers want more than just a bargain bin.
It's about engagement. So putting it all together, what should you be thinking about?
Well, that market reaction says a lot. Even with the buybacks and the slightly raised low-end guidance for the year, investors are clearly worried about near-term profits.
That soft Q3 guidance and the rising SG&A just overshadowed the steady sales.
And the stock hasn't exactly been a star performer lately, has it? Lagging the broader retail benchmarks like the XRT ETF.
Yeah, down about 7.3% over the year versus the XRT being slightly up. So the pressure is definitely on management to show these investments are working.
So key signals to watch. Number one has to be expense execution.
Absolutely. Do these investments actually drive growth and expand margins eventually? Or does SG&A stay stubbornly high?
Second, that digital transformation. Does the new app and website actually move the needle? We need to see stabilization, then growth in the direct channel.
Third, how does that new distribution play out? The college bookstore thing. Is it successful? Does it lead to more third-party deals? Crucial for reaching Gen Z.
Fourth, tariffs? Can they really mitigate that $85 million hit long-term through optimization and pricing? Keeping an eye on gross margins there.
Fifth, the consumer. Management says they're still cautious, value-seeking. Can Bath & Body Works really reduce promotions and drive AUR by talking up product benefits in this environment?
Big test. And finally, the CEO's longer-term vision. These no-regret moves are clear, but what's the full picture for sustainable traffic, AUR growth without just giving stuff away and getting those margins back up?
We need more clarity on that long game.
Okay, let's switch gears slightly. Time for our strategic angles to ponder segment. And just a reminder, this is purely for discussion, thinking about strategy, definitely not financial advice.
Exactly. Thought experiments. Okay, first angle, the omni-channel optimization play.
So the idea here is, what if BBWI really nails that internal supply chain optimization, exiting third-party fulfillment, leveraging their US base?
And at the same time, their digital upgrades and new distribution, like the bookstores, really work to expand reach efficiently.
Could they gain a significant edge over retailers still stuck with older, maybe less efficient external logistics partners?
Right. The angle ponders if BBWI is building internal efficiencies and smarter reach that the market, currently focused on SG&A costs, might be missing, while traditional logistics firms maybe face headwinds.
Interesting. Okay, second angle, the rebranding and reach arbitrage.
This focuses on the CEO's push to remarket classic scents, mahogany teakwood, champagne toast to new people.
And amplifying that product efficacy message, the ingredients, the benefits, specifically for Gen Z.
Combine that with the low-cost college distribution and the revamped social media strategy. Could they create significant new brand heat in customer acquisition?
So the thought experiment is, if this rebranding and reach strategy really catches fire, could it drive sales way beyond what people expect right now, especially compared to, say, legacy department stores struggling with old models and constant discounting?
It's about that potential upside if the brand refresh truly connects.
All right, so wrapping things up, Q2 for Bath & Body Works showed stable sales, but a slight EPS miss and rising costs, leading to that cautious market vibe.
But we have a new CEO with clear, no-regret moves, fixing digital, boosting product value perception, and finding new ways to reach younger customers.
Near-term headwinds from tariffs and investments are definitely there, but they've reiterated strong cash flow and upped the buybacks.
So the path forward really hinges on execution. Watching those digital numbers, the new distribution tests, and whether they can manage costs while delivering on that growth vision.
So, here's a final thought for you to chew on. Thinking about Bath & Body Works trying to make classic fragrances cool again for a new generation. What other classic brand or product out there, maybe one you know well, could potentially pull off a similar modern refresh and targeted push to capture today's consumers?
That's a good one. Lots of potential candidates out there fighting for relevance.
Absolutely. Well, thank you for joining us for this deep dive on the Bath & Body Works earnings call. Remember, do your own homework. These are just our insights.
We'll catch you on the next deep dive.